This is international fundraising video for today, where we talk about international fundraising as it impacts non-US business owners who are running international businesses, non-US businesses. But the US is a point of reference because a lot of people want to raise money in the United States, and they want to raise money from accredited investors who tend to have a lot of their funds, their capital that they use either directly or as collateral for entering into transactions, acquiring shares, investing in companies and what have you. They have all these funds in regulated entities, private banks, regulated trust companies, private investment funds, which are basically regulated environments. The average international business owner has a holding company in Uruguay or US or UK or Canada, and an operating company underneath that. And that essentially is an unregulated structure, an arrangement. And so interacting, an unregulated structure, interacting with a regulated structure is actually highly problematic. It can actually, your transaction will actually likely be blocked by the compliance department of the private bank or the trustees or the fund managers if what the investor is seeking to do is either invest in unregulated structure or acquire an unregulated business. Yeah, even though after you've negotiated all of the commercials and agreed on everything, if you have an unregulated structure, you're likely to run into problems. And why is this? U.S. accredited investors and institutions, regulated financial institutions in the U.S. The U.S. is a massive domestic market, and we all read and see about all the very dynamic deals and deal activity that is always underway in the United States. And so this being done domestically for U.S. persons, raising money for projects where there are, non-regulated fund managers, like limited partnerships with real estate developers and LLCs and all these things. All this transpires in the U.S. A lot of it is not regulated because it doesn't need to be regulated. It's exempt. But these projects and this activity is all U.S. domestic, and a lot of it is U.S. persons, and a lot of it involves U.S. banks, U.S. financial services institutions. As soon as you introduce an international dimension to that, non-U.S. dimension, and you are a small family-owned business, and by small I mean less than $100 million, you're running into the, you're perceived as a high compliance risk. And why is this? Because regulated institutions have compliance departments or compliance now, which is increasingly regulated. Just yesterday, we saw the day before, I think the Wall Street Journal reported that Google is entering into the providing banks with money laundering, digital online money laundering services. Of course, Google has a massive amount of data, billions of users. The transparency, that is a material development. They will bring substantial transparency to the financial system when they apply it to offer money laundering systems to banks. If you think of all the current compliance databases and online services, WorldCheck, it doesn't matter who they are, none of them have the type of scale and platform that Google has. So this is a massive development. And so this is going to continue because the artificial intelligence is going to have a big impact on compliance as well, because banks and institutions are going to automate these things. They're going to deploy these systems, to protect their regulated status. And the global regulated financial system is just going to become more transparent every day. And so as a result of that, what we're seeing, our business partners are telling us what we're seeing. We work with a lot of fund managers, asset managers, other asset managers. What we're seeing is that clients in private banks are beginning to move their funds out of private banks and into private investment funds. Because when you set up a private investment fund, the money and the assets are more in your control at the regulatory level. You're not necessarily as much subject to the management systems and controls of the bank. You now have a lot of your own responsibility. So the way that a private investment fund will interact with a bank or be treated by a private bank is completely different to if you are a private individual or a trust that is placing funds on account in a private bank. It is a completely different relationship. And so this is why clients are moving billions of dollars out of banks into private investment funds. And then, of course, as a private investment fund, which has its own regulated asset manager, it has its own compliance checks and administrative functions and on all these different things. What that means is that there's a lot more autonomy, there's a lot more control, and the money is not necessarily under the control of the employees of banks. Banks are increasingly stretched because of the increasing compliance of the financial system. It's not easy. It's not as easy anymore to do things, to overlook things as it was in the past, and banks cannot hire enough employees to deal with all these things. And not all banks have the billions of dollars that will be required to migrate from legacy systems to digital transformation, and to take digital transformation to move to more digital automated systems that could bring economies of scale across the entire bank. And this is just the services, not just compliance. So you've got a changing landscape. Banks have hundreds of thousands, tens of thousands of customers, and the financial system is becoming more complex every day due to automation and AI and Google and all these people entering the compliance system. And so, if a system is becoming more transparent, there could be more suspicious activity reporting, which is going to cause more problems for clients. Clients are going to be forced to provide more compliance information to banks. But a lot of this is reduced and mitigated when you are running your own private investment fund. You do your own compliance. And so you won't run into those same compliance problems where the bank is refusing to act unless they get more information from you. Sometimes the banks and the compliance departments, they don't even understand what you're doing or why you're doing. Well, they're not commercial business people or experts in your area. And so it takes a lot sometimes to explain to banks, what your business plan is, what your marketing plan is, or why you're doing various transactions. Private investment, having your own private investment fund and deploying from there. So you set up a private investment fund which owns your operational company, and now you will have a completely different relationship with your private bank. They will leave the regulation of the compliance of your affairs to you because you're a regulated entity now. You can now more easily deal with accredited investors who have their money in private banks. Private banks will, the compliance department will not see you as such a high compliance risk if you have a regulated private investment fund in place. So it's easier now for you to raise funds from investors, and you won't be blocked by either the advisors or the compliance department of the private bank. And finally, even for instance, if you have a private investment fund and you're due to do an exit, ultimately, if it's a accredited investor or investors who are purchasing your business, you may find that your transaction is delayed, held up, or cannot even move ahead because the private bank or the private banks involved in the situation where the purchaser is basically trying to acquire the shares of your business could actually be blocked because the compliance department of their private bank might not want to take on an unregulated structure and add that into the trust structure that your purchaser is using. Alternatively, the purchaser might have problems if they're using their portfolio as a collateral to raise a credit line at another private bank. Again, that transaction could be blocked because the compliance at the private bank might not want to open up a credit line and have funds deployed to an unregulated structure, which has, from their point of view, high international risk. So I think it's becoming clear, the word is out, people can see this, that having your own regulated platform, private investment fund, your own regulated asset management company, or you working with a regulated asset management company, depending on how you want to do things, I think is really becoming the ideal way forward. And I think people can see that because the financial system is just becoming way too transparent, and compliance is really biting and taking effect. At the same time, if you are doing your own compliance, you can benefit from the benefits of from the realities of artificial intelligence, automation. You can reduce costs, but the point is, your business, what you're doing more than anyone else. It's a waste of time, to be honest, trying to explain the intricacies of your business and why you're doing what you're doing to someone who has no experience in your sphere of operations. It's very difficult, as we all know, for non-commercial people from outside of the culture, the market, to understand, the laws, the nuances and everything else. I mean, they just don't understand it. I've had to explain to a number of, U.S. lawyers that, say, for instance, that limited liability in South America, many South American countries, is not the same as it is in the United States, where in the United States, UK, and Canada, it's somewhat absolute. In South America, it's not absolute at all, and it's very different. And these are things, so therefore the behavior of directors and legal representatives and managers is very different to in places like South America, to how those individuals, directors, would behave in the United States. And so, someone in a compliance department might not understand the arrangements which have been undertaken. But spending lots and lots of time writing reports, trying to explain that to someone that you'll never meet, because you'll never be allowed to meet the compliance department of the private bank, and don't feel good when you send the email to your relationship manager, because they probably they can't go and meet they're barred from meeting the compliance department. Also, they can probably just pass on the information. So we will be talking a lot more about private investment funds and how they can reduce the cost of capital, reduce compliance risk, put the ability to do fundraising, improve that greatly. They can increase the international tax efficiency tremendously, because private investment funds can get a lot of access to tax treaties and tax efficiencies. and they can also provide a range of confidentiality, especially for people in Latin America who are concerned about confidentiality. There's a lot more scope to achieve confidentiality when you're using private investment fund, because you can still have a private investment fund which is an active entity, and you can still do your custodying in the United States or Canada or wherever. So there's lots of different ways to do it, and we will outline more on this in the coming videos. Cheers for now.